Alan Greenspan coined the term irrational exuberance in 1996. What that meant was that the United States would have a stock market that would continue to go higher based on many unforeseen reasons. And many people bought this explanation. However, the reason why the stock market went up was solely because of central bank intervention and nothing but that. Yet nobody seems to acknowledge that fact. In 1995, the year before, there was the reversal of the Plaza Accords. The Plaza Accords, first of all, was an agreement between the Japanese and the United States in the mid-80s, where the United States would let their currency depreciate while the yen would have their currency appreciate. Remember, the Dixie, the dollar index in the 1980s, was a strong currency, approximately 150 on the Dixie. And then the US dollar continued to slide, steadily but slowly, up until the mid-1990s. And the Japanese yen actually appreciated during that time frame. And the Japanese were throwing a fit, just as the American manufacturers were throwing a fit in the mid-1980s. Now, the Japanese stated that we want a weaker yen. The United States said, okay, here are some restrictions or here are some requirements. And in this quid pro quo agreement, the Japanese would have to purchase US treasuries while the United States would allow the Japanese to let their currency depreciate. A few other factors to consider: the Japanese, in order to weaken their currency, cut interest rates. And what ended up happening was, yes, the United States had lower interest rates, but they also had a stronger dollar and a rising stock market, which many people would find surprising with a stronger dollar. But, long story short, a yen carry trade emerged, where investors would take the yen and invest and borrow in higher interest rate currencies. Thus, what ended up happening was that as long as this Ponzi scheme continued, people would take the yen, borrow in higher interest rate currencies, invest there, and then convert that back to the yen. And what ended up happening was you saw the stock market go up from 96 all the way to 2000, the NASDAQ bubble. It appears that there could be a Plaza Accords, reversal of Plaza Accords Part 2 over here, even though there was no such agreement announced. And eventually what happened was that the Japanese yen continued to appreciate at that time. And they were throwing a fit. And what ended up happening because of Fukushima? The Japanese said, you know what, we're sick and tired of a strong currency, we want to let the currency depreciate. And we've seen a declining yen since 2011, around this time frame. And from this time frame all the way to roughly today, we've seen the stock market go up in a straight line. So it's the yen carry trade again, this time on steroids, where everyone is printing like crazy. So taking the yen, borrowing, investing in higher interest rate currencies such as the United States, and investing in the stock market. Now you have liquidity from Europe as well, and other central banks around the world that want to debase their currency. Thus, it's going to the stock market, and that's where all the inflation's at. And this seems to be like 1995. And this lasted approximately 4 to 5 years, and then the bubble popped. And it would not surprise me if we see a similar situation like from 2011 to 2015, maybe early 2016, and then this bubble pops. Especially with Janet Yellen printing probably more than Greenspan, or probably more than Ben Bernanke. Thus, if you want to look at a few other factors, Warren Buffett stated that he does not find anything adequately priced. He may be too early, but he usually goes in and out of the market right before everybody else does. And if you want to look at a few other factors, oil's around $93 a barrel, and if this market continues, you're going to probably see higher oil prices, and if it gets too high, the bubble, in my opinion, is going to pop. So, if you want to look at it, this is basically Irrational Exuberance Part 2, where the Federal Reserve and central banks around the world are created distorting asset prices. Some people may not acknowledge this, some people may be fans of what the Federal Reserve is doing, but they're actually not creating real growth, because you're seeing ridiculous PE ratios such as Amazon, which is 1250. There's no way that a normal market would have a PE ratio of 1250. There's no way you would see Potbelly, the sandwich store out of Chicago, have a PE ratio over 300. Yelp, around 300. Netflix, approximately over 300. These PE ratios are ridiculously out of whack, and they may continue to be out of whack for the next year or two, eventually until free market forces take hold. And when that happens, no one will be talking about irrational exuberance